Good afternoon, everyone, or good morning, depending on where you're joining from. We're really glad that you were with us today. Today, we're going to talk about government contract unallowable costs. We have Robert Jones with us today from Left Brain Professionals. Robert has been presenting with us each month throughout the whole year on different topics related to government contracts. And this has been a fantastic series, so we're glad you're jumping in. Maybe you've had a chance to join us along the way. My name is Liz Brigson. I'll be your host for today. My goal is just to help you get the most out of the presentation. So there's just a couple things I'd like to point out. First thing is that we like to make our webinars interactive. So if you've joined us before, hopefully you've had a chance to jump out to the questions box and say hello, which it looks like some of you have already been able to do that. And if you're new here, we would love for you to find the questions box and go to webinar control panel and let us know where you're joining from so that we can welcome you. Also, I'd like to direct your attention to the handouts. You can download the handouts from the GoToWebinar control panel under the handouts section. You can also get the handouts from your Incourse dashboard, which will be helpful for later, but I know you'll want to keep these handouts for future reference. We have a 1.5 hour webinar for you today. So we will launch 7 poll questions. To earn CPE credit, you'll want to respond to at least 5 of those 7 poll questions. If you qualify, you'll be able to get your CPE certificate from your Incourse dashboard an hour after the program ends. We do love it when you can respond to all of the poll questions. It just keeps it fun and interactive to have you all engaged. Lastly, if you have any questions about the webinar, you can always email us. Our email address is support@incourse.com. All right, well, it's my pleasure to welcome back Robert Jones. Robert is a government contract and accounting expert. He has a master's in accountancy from the College of Charleston, and his experience in business has really spread from business management, compliance, operations. He's been a controller. He's been a defense contracts manager. He's an instructor or an incredible educator. He's working on writing a book, and I just don't think that you'll find a more qualified government contract accounting expert out there. So Robert, with that, it's my pleasure to turn things over to you, and you can go ahead and just take it away.
Good morning, good afternoon. Thank you, Liz. Always a pleasure to be back here with the Incourse team. We are here today to talk about unallowable costs. You'll see there on the screen that I asked Jenny, my marketing person, to help me out and make sure that we underline and italicize that un portion throughout this. Today, you will hear me use the words allowable and unallowable. I try to stress that to avoid any confusion, but hopefully the visual indicator will help you out as well. So a little bit about us. Our firm is Left Brain Professionals. We are government contract accounting specialists. We're a boutique accounting firm that serves only government contractors. We practice primarily accounting system design, implementation, audit support. We do get into training as we're doing here today, and a little bit of cybersecurity compliance. Some of the tasks that we get involved with our clients include indirect rates. If you've been, as Liz was saying, this is now number 8 in a 12-part series that we're delivering this year on government contract accounting. If you look at the screen, if you've been with us, some of those topics will look familiar. We previously talked about cost and price analysis, cost accounting standards. Today, we're hitting on that unallowable costs. And if you come back through the rest of the year, we're also going to get into timekeeping, labor distribution, and the incurred cost proposal. Some of the other members of my team that you may interact with if you give us a call or email, Melissa and Stephen there, be happy to help you out at any time. Our learning objectives, let's just dive right into the content here today. You should, at the end of this presentation, be able to describe the FAR 31 cost principles, list some of the common unallowable costs and their issues related to those, explain the best practices for the treatment of unallowable costs, and describe the impact of unallowable costs on indirect rates. With that, we do have a polling question to kick it off here. Liz, please.
Okay, sounds good. So just to start out on the topic today, we'd love to hear your feedback. What is your level of knowledge on unallowable costs? While you're responding to this question, also want to be sure to let you know that we have Jenny on the line from Left Brain Professionals. Jenny is going to be in the background, just monitoring your questions as you're asking them. And as we take breaks for poll questions and get toward the Q&A time at the end, Jenny will be sure to read your questions so we can address them. So thanks everyone for submitting your answers to this poll. We'll leave it open for about 5 more seconds. And we'll close it down and take a look at those results. All right, so this looks like a pretty good distribution curve, Robert. We have some pros with us, some folks who are brand new, and then in the middle, over 80% of the audience is in that either I know a little or I'm proficient and I'd love to learn some best practices. So that's great to see.
Yes, good information, and hopefully then at the end of today's presentation, you'll get some people to move up towards that pro level of unallowable costs. So what are unallowable costs? That's one of the questions, obviously, when we start talking about government contracts and you use that term. And it's a unique term, right? It's a term that you don't hear elsewhere in accounting. So I always like to clarify exactly what we're talking about. And essentially, unallowable costs are those costs that the government has otherwise deemed or determined that are not necessary for contract performance. It's important to note that these are usually legitimate business expenses, right? These are things that you would otherwise do in business that you would pay for, but the government says you don't need to incur those kinds of costs, or we will not reimburse those kinds of costs on the government contract work that you do for us. The other thing that gets confusing, and this is usually where the business owner stands up and begins to have a mini panic attack or a heart attack and says, what do you mean they're unallowable costs? Okay, we're not talking about tax deductibility, completely separate conversation. In fact, again, because these are usually legitimate business expenses, they are often, but not always, tax deductible, and we have to insert my little asterisk there and say, always please discuss any of these with your tax advisor. For example, we know meals and entertainment tax deductibility changed at the beginning of 2019 with the Tax Reform Act. So even though, again, they may be legitimate business expenses, they may or may not be tax deductible. All right, so let's dig into what is FAR 31. And I'm usually not one to do a lot of quoting out of the FAR just because I don't like to put a lot of text on slides, but there are times in some of these presentations where it's really important to drive home what the regulations state. So what we've got here is some text. This comes straight from the FAR. The scope of FAR Part 31 says that this part contains the cost principles, and in fact, that's the title of FAR 31. It's contract cost principles. And it's the procedures for the pricing of contracts, subcontracts, and modifications to those contracts and subcontracts whenever cost analysis is performed. Take note there, cost analysis, not price analysis. And when the determination, negotiation, or allowance of costs when required by a contract clause. So when we talk about FAR 31, this is at a high level what we're talking about. When we talk about FAR 31, and we'll get into the specifics of some unallowable costs in a little bit, people often jump to that section. It's FAR 31.205, and people often go there, and they sometimes skip the opening section of FAR 31. And you can miss some really helpful foundational information if you happen to do that skip. So go to FAR 31, start at the top, read through the basic guidance there, because it does provide more information to help you interpret and deal with these specific unallowable costs that we'll talk about in section 205. It's important here that you see there's again, specific guidance for fixed price contracts, for contracts with commercial organizations, educational institutions, anybody in the construction and architect engineer world out there. Again, there's some very specific requirements in there. Leave the one in here just so you know I didn't skip it. There's a section that's reserved. If you have contracts with state, local, or federally recognized Indian governments, contracts with nonprofit organizations, and then certain advance agreements. Again, the reason we point out this list to you is there are some very specific things that you need to know if you're dealing in one of those contract types or one of those industries. So what is cost allowability? Cost allowability, again, this is a definition straight from the FAR. It says a cost is allowable only when the cost complies with, note here, all of the following requirements. Okay, and we've got a few things we're going to talk about. The cost has to be reasonable. It has to be allocable, and we're going to define those in another slide, so just stick with me for another minute or so. The cost has to be in compliance with the standards promulgated by the CAS board, the cost accounting standards, if you recall. We did a presentation on that. If CAS is applicable to your contract, and otherwise needs to be in compliance with GAAP, and the practice is appropriate to the circumstances. Little interesting note here, I have had a couple of people when they start looking at and hearing about some of the specific government contract accounting requirements, I've had somebody look at me and say, well, does this stuff even comply with GAAP? Yes, it all complies with GAAP. It has to comply with GAAP, right? Because we're still dealing with financial statements. The way I describe what I do and what we do as a firm to people is, you know, when you go in business, you know, you have to register with the state and the county or the city, whatever the case may be, right? You got to set up payroll, taxes, and all of that, right? There's a layer of paperwork and bureaucracy that you have to deal with. And from an accounting perspective, that's true too, right? So it doesn't matter what type of firm you are or how big you are, there are at least certain aspects of GAAP that apply to the way we do our books. Well, in the government contract accounting world, there's that other layer, and that's what I tell people that we deal with. It's dealing with that other layer that rests on top of GAAP. The fourth item, the cost is allowable if it's in line with the terms of the contract, and then if it aligns with the limitations set forth in this subpart. And that part 31.2, specifically 31.205 is where we'll get into those, some of those detailed enumerated costs. Got a polling question here, please, Liz.
All right, so let's jump into poll 2. Poll 2 is, a cost is allowable only when it complies with the following requirements: reasonableness, allocability, terms of the contract, all of the above. Looks like responses are coming in very quickly, which is great to see. We'll close this down in about 5 seconds. All right, awesome. It looks like the majority of the audience answered all of the above, which appears to be the right answer. So that's fantastic.
That is, yes, that is the correct answer. So everybody's paying attention early in the presentation. All right, we're going to dive in and explain a couple of those items on the previous slide. There were 5 requirements there. So the first is reasonableness. So what is a reasonable cost? It's reasonable if in its nature and amount, it does not exceed that which would be incurred by a prudent person in the conduct of competitive business. Another way to think about this is that arm's length transaction, right? What would you charge somebody who's not related to you, that you don't have any kind of business or other relationship with, right? So somebody walked in off the street, what would the amount of that transaction be worth? And that's where reasonableness comes in. There's also another aspect of reasonableness, and I'll kind of jump ahead a little bit. We'll talk about airfare and travel expenses, but the one that I like to do to describe reasonableness is, you know, when we go search for airfare, so I'm now in Palm Springs, California. If I want to fly back to Columbus, Ohio, where we were, right, I go punch that in, and I'm probably going to see flights anywhere from like, you know, I don't know, $149 on, you know, Spirit or one of those really low cost airlines, and probably all the way up to, you know, a few $1,000s, right? If I wanted to fly first class, or I wanted to hop on a plane in the next couple of hours, right, that price could get really expensive. So what is a reasonable cost in that range, right? If the price ranges from 150 to 3,000, what's reasonable? Well, if most of the flights are around $300 or $400, then that's probably the reasonable cost, right? It probably is not reasonable to pay 2, 3, 4, 5x for something just because it's available. A cost has to be allocable was one of the requirements. So what is allocability? It's allocable if it's assignable or otherwise chargeable to one or more cost objectives. You may recall we've used, and if you've been with us in this webinar series, we've used that term cost objective, such as a final cost objective when we were talking about direct costs. So those are those direct customer projects. An intermediate cost objective is something like overhead or G&A. Right, so if a cost is allocable or assignable to one of those cost objectives, either because it was directly assignable or because of the relative benefits that were received, right, or that relationship, again, for something like an overhead or G&A. It says a cost is allocable to a government contract if it is incurred specifically for the contract, otherwise known as a direct cost. It benefits both the contract and other work and can be distributed to them in a reasonable proportion. That's overhead. Remember, again, when we talked about direct versus overhead and G&A, again, in that previous webinar, I said, overhead costs are those costs that we incur to support all of our customers or clients or projects or services. I can't necessarily assign that cost to any particular customer or project, but it benefits a lot, right? So that's basically what this is saying here, that if it benefits the contract and other work and can be distributed accordingly, then we treat it as overhead, or it's otherwise necessary to the overall operation of the business, G&A. Remember I said that those G&A expenses are those costs that you incur to run the business, regardless of any amount of customers or clients that you have. And G&A are things like accounting, legal, HR, business development, stuff like that. We said the third requirement in order for a cost to be allowable at top level, it has to be in compliance with CAS and GAAP. Again, just a quick reminder that CAS are the cost accounting standards. That's that additional layer of stuff that applies to some contracts. If you did not watch or participate in the CAS webinar, I highly recommend that you go back and pick that up because there are some aspects of CAS that may and can apply regardless of whether or not you have a CAS covered contract. So always be sure that you're aware of that. And it has to be in accordance with GAAP, right, or generally accepted accounting principles. In other words, right, we have to have an acceptable treatment of the cost for financial reporting purposes. It's that baseline accounting that we're talking about here. We said that number 4 for allowabilities was that had to comply with the terms of the contract. So it's really important here that you know what's in your specific contract. This is an area where we see clients get in trouble. Okay, because they think, oh, well, we normally charge this stuff to a contract. They go ahead and charge it to a contract. They submit an invoice to their government customer or to their prime if they're a subcontractor, and the invoice gets kicked back, and the contractor or client is calling us saying, what's going on? We don't understand what's happening. We always charge this. Well, did you read the terms of your contract? Maybe it was specifically excluded. Right, so there can be times where there are some costs that are clearly enumerated, right? They're defined, specifically outlined as unallowable for that contract. If it's in there, it may otherwise be allowable on other contracts, okay? It may otherwise comply with some of the other things that we've talked about, but if your contract says that it's unallowable, then it's unallowable for that contract, and you have to treat it as such. It simply may not include costs. This is what I call unallowable by omission. Travel is a big one of these, right? So you have an RFP, you put together your response, you send it in, the government or your prime awards the contract, and at some point down the road, you realize either you're going to need to travel, and maybe you didn't think you had to travel when you prepared it, or for whatever reason, maybe somebody overlooked travel, something happened, travel didn't get in the proposal, It didn't get in the award. Now you have travel costs. You invoice your customer, and your customer comes back and says, you didn't propose travel, travel's not in the contract, and I'm not paying for it. I will insert here that sometimes, and it's certainly up to the discretion of your prime and your, I'm getting an error message. It's asking me to turn off my webcam for a moment, so you're going to see why I disappear here. You may get your prime or the government to issue a modification to add in something like this travel that got omitted, but they may not, and they're certainly not required to. That's why, again, it's very important that you always check those proposals, check the award when it comes in, because if that's not there and you can't bill for it, then now you've incurred a cost that you cannot recover. Okay. As well in the terms of the contract, this is something we don't see as much, but it has happened where we've seen the contract call for a cost to be treated as direct that the contractor normally treats as an indirect. A perfect example of this were background checks and some equipment for a company that does staffing, right? So this is a government contractor that they provide staff, not a recruiting service, but they actually provide the staff to the government facility or to the prime's facility. And normally, when we talk about background checks, those are usually an indirect expense. Could be overhead or G&A, the arguments for both. But it's normally an indirect expense, right? Because we don't deliver that to our customer usually. However, we've seen contracts, again, in this staffing world where it says you will perform the background checks, it's a requirement, and we want you to treat it as a direct cost. So in that situation, what they had to do was make sure that when they hired the people for that contract and they paid those background check fees, that they got coded differently than the background check fees for other work that they do. And if you run into a situation like that, really with any of these, you want to make sure, and we'll talk more about, you got to document. But in that situation, you want to make sure that you document why you treated a cost one way for one contract, but a different way for another contract. I'm going to try to turn on my webcam again here really quickly. Carrying on, number 5 in our list for allowability was in compliance with this subpart. Specifically, we were talking about FAR 31.2. And we're going to dive in a little bit today, here in a few moments. FAR 31.205 is a list of 52 enumerated costs. So there's 52 specifically identified types of costs. We're not going to go through all 52. We don't have enough time for that today. Would probably turn into an all-day webinar. But we have selected some that are common issues that we run into that we want to share with you and share some specific guidance on how to deal with them. You want to know here that these 52 enumerated costs, if the FAR says it's an unallowable cost, it's deemed, and this term is important here, what we've got in quotes, that expressly unallowable. It is written black and white, very clear. The FAR will say this cost is unallowable, not debatable. And I'm going to tell you right now, you're not going to win that argument with DCAA or any other auditor. And I've had that conversation with clients, and they don't like it. And they say, well, I'm willing to go argue with the auditors. You can go argue with the auditors. I don't recommend that. It's probably not, you're not going to get the result that you want. And if you want to argue about something, let's find something else where we have an opportunity to argue. You know, this is pretty clear. It's black and white. They're not going to budge. You might as well accept it and move on. With that, when we talk about accepting things and moving on and knowing what you're going to claim, you want to know here the burden of where the burden of proof is. So if the burden of proof is that a cost is unallowable, it's on the government to prove that it's unallowable. And you might say, well, that's fine, then they have to deal with it, not me, so why do I care? Again, in the terms of this expressly unallowable approach, they've got a pretty easy argument. And I can tell you that if it goes up the ranks in the audit agency, or if, God forbid you were to end up in mediation or in some kind of a court case or whatever, again, when it's black and white, people are not going to be on your side. Now, if it's one of those gray areas, and we'll talk about some of those, then again, maybe that's where you want to put your argument power. If proving that a cost is reasonable or that it's allocable, again, reasonableness is, is this a price that a prudent person would pay in competitive business? That is on you as the contractor, as well as proving that something is allocable, meaning that it's otherwise assignable to a cost objective, whether that cost objective is direct or indirect. With that, Liz, we've got another polling question, please.
All right, sounds good. So poll 3. A cost is reasonable if, in its nature and amount, it does not exceed that which would be incurred by a prudent person. And while the audience is responding to this poll, Robert, can you finish what that statement is? I didn't have enough character space to include the tail end of that statement, but I thought it was very interesting.
Yeah, so it says a cost is reasonable if, in its nature and amount, it does not exceed that it would be incurred by a prudent business person in the conduct of competitive business.
Yeah.
And hopefully you were paying attention I gave that answer away just a little bit ago. And seeing the polling results coming in, I think everybody is getting it here. I think we've got most people that have voted, so if you want to close that. The answer here is true. The answer is true that the cost is reasonable if it's something that a prudent person would pay.
Awesome.
All right.
Thank you.
Yes, now let's dive into some of these common unallowable costs and the related issues. Again, there are 52 that are identified, and 52 types of costs or categories of costs. That if you're not familiar with FAR 31.205, please make a note, go to acquisition.gov. That's our preferred source for looking at the FAR, acquisition.gov. You'll see a little button right on the home page that says Browse the FAR. When you go in there, over to the side, there'll be a little box, and you'll see 1 through 52 that you can click on the number, and that'll take you in to be able to read the FAR. Again, though, you'll find 52 in there. We don't have time for all of them today, so we're going to go through some key ones. And again, I'm going to pause here and just reiterate, this concept of unallowable costs. These are costs that the government has, and I'll try to explain why on some of them. The government has said, yes, these might be legitimate business expenses. You might incur them for your business as a whole. You might incur them because you have commercial contracts and other non-government work, and that's fine, but you can't include any of those costs in your rates or your billings back to us in the government. First one is advertising. And this is a key example here where you also want to get in and make sure that you read the entire portion. You want to read that entire clause. So if you said, hey, I got an advertising cost, is this allowable? Is it unallowable? The reason I'm telling you to read the entire clause is because there are portions or types of expenses where a portion of it may be allowable, but most of it is unallowable, or vice versa. There can be a situation where most of it is allowable, but a small portion is unallowable. You want to make sure that you don't just go along and say, oh, it says allowable, I'm done reading. Nope. Make sure you read all of it. And as well, just like with other legal stuff, sometimes there's a reference to another thing. It'll say, these are allowable as long as they're in compliance with, another FAR clause. Now you got to go read that other FAR clause and make sure, okay, sounded like it was allowable here. Let me go read the details over here and see, is it, do I meet any other criteria? When we talk about advertising, job postings are allowable, right? I mean, because you got to, whether you're hiring people to work your commercial work, your government work, or hiring somebody to work in G&A, right? You got to do job posting, an allowable expense. What I refer to as general advertising. That's where, we get out and say, hey, we're a wonderful company. You should hire us. Look how smart and good we are. Look at all these awards that we've won. That kind of stuff, generally unallowable, right? Because all you're doing is tooting your own horn, and the government says you don't have to toot your horn to win the contracts with us. We're not paying for those expenses. Again, you probably otherwise want to continue, spending that money. It's the right thing to do to grow your business and to get visibility. You just can't include those in your rates back. There is some limited allowability. Again, this is where you got to read the finite details. Make sure you also understand exactly what the cost is that's being charged. There are some limited exceptions where general advertising is allowable. Public relations, generally unallowable. Again, this is where we do those things, not just advertising, but we do other things that tell people how good we are and all this stuff. Generally unallowable unless it deals with public safety. So let's say, for example, you manufacture a product and there's now a defect in your product and you need to do a recall, right? You got to get the information out to consumers or business, whoever has bought this, right? That this product is no longer safe. It needs to be repaired or returned or whatever the case may be. Something like that is an allowable cost, right? Because the government and users within the government may have bought your product and they need to know that there's a recall on that item. Alcohol, pretty simple, straightforward, unallowable. They're actually, we like to joke when we teach this course sometimes and say there are two examples, and we don't have I don't have the best ability here for the interaction with this, but there are two examples, and I'll let you think about it for a moment as I describe, where alcohol might actually be an allowable cost. So I'll tell you generally why alcohol is not allowable, right? Your employer, when you travel, might say, and we see this in a lot of policies, the employer will say, we will reimburse the employee one alcoholic, right, adult beverage per night of travel, right? So you're on travel, you get back to the hotel, whether you go out, maybe you go downstairs to the restaurant or bar in the hotel, or you order a burger, you say, hey, it was a long day, I want a glass of wine, I want a glass of beer, whatever the case may be. Your employer might say, we're willing to reimburse you one. The government looks at it and says, yes, the person was on travel, they were doing work on this government contract, they have to eat, we will pay for the meal, but they didn't have to drink alcohol, so we don't pay for alcohol. And so generally the government just doesn't pay for alcohol. You can probably kind of understand why, right? But there would be two limited exceptions where alcohol would be allowable. One is, what if you were a research firm and you were studying the effects of alcohol on something, right? And the government had hired you to study the effects of alcohol. Well, obviously, you'd have to buy alcohol in order to study the effects of alcohol on something, potentially, right? You might be having a situation where you allow people to drink and you put them through some kind of test. Well, you'd have to buy the alcohol to do that. So that would be one limited exception. Melissa, one of my colleagues, you saw her picture early on. The one that she likes to say is, at the christening of a ship, right? We've got to have about a bottle of alcohol to break against the side of the ship, right? So if we're the contractor and we built the ship and we're there to help christen it, right? We got to buy that bottle of alcohol. Those would be the two limited exceptions. Bad debt, unallowable. Pretty simple, straightforward, not much to argue with. And again, those are like the two here. When you look at them, they're pretty short and sweet in the far. These are ones that you're not going to win the argument. I wouldn't say, hey, I'm going to go to battle with the auditor on these. Charitable contributions, another one. Unallowable. There's a limited exception for certain aspects of advertising that are related to charitable contributions. And a great example of that is a blood drive, right? As a company, many companies will oftentimes host a blood drive. They may only do it internally. We've seen a lot of times where a company will host a blood drive, but they'll open it up to the public to come out as well, and they'll do some advertising. Something like that, again, it's benefiting the public good. It's not necessarily, yes, obviously you're getting some visibility because your company name is going to be on it. They're probably coming to your campus or whatever, but it's not really about you and selling your products, right? You're trying to do a good thing for the community by having a blood drive. That would be the limited exception. Otherwise, charitable contributions, unallowable, they're still the right thing to do for your business, right? We should be, and I hope that you are a good steward in your community, that you're giving back, whether it's in these difficult times that we're through or in otherwise normal times, right? Be a good member of society, be a good neighbor, and give back. You just can't include that in your rates back to the government. Another one that gets a little confusing is employee morale. So there are a number of things that are involved in employee morale. There's a very good description in the FAR on this. If you have a single employee morale GL account, you're going to need to want to break it out. You're going to want to make sure that you understand what expenses are getting charged to that, because some are allowable, some are unallowable. If you have health clinics, right? So I know when I used to work for a large business employer, you know, they would have, and I remember one time they brought in a truck where we could go have a heart exam done, you know, so they did an EKG and some other stuff, and they do the same, they give you this report. You know, if you have the mammogram bus that comes by to your facility, right, health clinics like that, things like that you're paying for, those are allowable. Wellness, you know, we got my previous employer, we got them to start a wellness program where they started offering fitness classes and some stuff on site and doing some other things with wellness. That's an allowable expense. If you have a fitness center, if you pay for fitness memberships. So again, one of my previous employers, we could go, they had a specific gym at the time that they had a relationship with, but if you went to the gym, you paid, and then they got a report at the end of the month. And as long as you went to the gym at least 8 times, then they didn't refund all of it, but we got, I don't know, $10 or $15 back a month, something we got back out of that, right? So again, we're doing something to advance the health and wellness of our employees. That's allowable. Other things that fall into employee morale, some meals and entertainment kind of stuff. The thing that I point out are there's weekly donuts and snacks. I finally got one of my previous employers we finally got them to alternate. For many, many years, every Thursday they brought in, and when I tell you stacks of donuts, we were a decent sized company, but still, there were stacks of donut boxes. And for the healthy person like me, I'm like, yeah, they look good, but I'm not going to eat that stuff, right? Can we get some fresh food or yogurt or something else? So we actually got them to balance it out as part of the wellness program that they implemented. That one week they brought donuts, and one week we had fresh food and yogurt. So it was a nice compromise. But what I'm pointing out here is those kinds of things are unallowable, right? Because even though the fresh fruit and the yogurt was kind of part of our wellness program, it's still a snack, right? It's not something that we have to do. And so again, they're great things to do. You know, we also used to have like a monthly birthday party for everybody that had a birthday that month. They bought a big cake, we had a big party. You know, again, nice. It's good for employee morale. It's the right thing to do for your business. May or may not be tax deductible. I got to really insert that here when we start talking about meals and entertainment kind of stuff. May or may not be tax deductible, but not allowable in our government contracts. Some other issues, interest and finance charges. So generally unallowable. And let me explain a little bit about this here to be clear. So if you have a line of credit, right, and you draw against that line of credit, right, you've got to pay interest on that. If you have a credit card and you don't pay off the balance, right, you're paying interest on whatever the balance is each month. Legitimate business expenses, otherwise tax deductible. But the government says how you fund your business is not really my problem. May not agree with that approach, but that's just generally what they say is how you fund your business is not really my problem. And part of the reason they do that is they're trying to level set the playing field and level set the rates among the contractors. I'm not saying that there's a set number that they're looking for. It's not a specific digit, that they expect to see as far as your rate. It's that they're saying one of the ways that we can level set competitive pricing among competitors, among contractors, is to say interest and finance charges are unallowable. Because what if you had a company that for whatever reason either they wanted to or they decided to hey, we're going to fund our business through borrowing money. That's just the approach that we want to take. And so they incur a bunch of interest expenses. Well, one, they could borrow money from owners and incur interest. So they could charge some rates and stuff. So you could see where potentially maybe some related party transaction issues. So the government just says no interest expense. And if you're a business that grows organically and you're able to fund the growth and fund your business generally organically, right, from profits and working capital, maybe you go after equity, right? So you're not paying interest. I mean, you're giving up obviously a percentage of ownership in the company, but maybe you fund the business through equity and selling stock. When you remove the interest and finance charges, then everybody's on a level playing field from that perspective. There is a limited exception in here, and on some of these, I didn't get into all the limited exceptions, which is why you'll see that I say generally unallowable. There are some interest interest charges that are generated at the state and local level that may be allowable expenses. But otherwise, interest and finance charges, credit cards, lines of credit, if you got a bank loan, for equipment or vehicles, all of that portion would be unallowable. Lobbying. And when I talk about lobbying, I'm going to bring up a subject that we've got some other, and I guess it's probably a good spot here for me to just go ahead and even jump to that. Lobbying is generally unallowable. And in the government contract world, there's a lot of lobbying that happens, right? Because as government contractors, people want the government to spend money in certain ways. They want, certain legislation to be enacted. I mean, and it doesn't matter what side of the political aisle that you're on. It doesn't matter what industry you're in, right? Whether you want them to add regulation or remove regulation or whatever the case may be, that you're trying to make, right? People lobby, and there are professional firms and people out there that is their job. They do lobbying, and you can pay them. You can get involved as well, but you can hire these firms and say, hey, I want you to go to Capitol Hill and knock on people's door and tell them this is, I want you to vote this way. I want you to do these things. I want you to change this law, right? Because it's going to benefit me as a business owner, and so I want that to happen. The government says that stuff is generally unallowable. Because, right, why would they want you to pay and why would they want to reimburse you, I guess is a better way to say it, to change the rules by which you're playing as a government contractor. I got a note here that says, watch out for those directly associated costs. And I guess I'll just go ahead and save that because we've got a separate slide. And I'll come back to this lobbying example when I talk about directly associated costs. Make a note of that. We'll get to it in just a moment. Rental costs. This is a big area that we deal with many of our clients. It's confusing. I will tell you that it's somewhere between frustrating and infuriating to business owners. I don't think I've met a business owner yet that's happy with how this is treated. Again, I will tell you that this is one of those areas that the FAR is very clear in what's written and what's enumerated. This is an argument you will not win with the auditors, okay? So I don't know a polite way to say it, but buck up. I think it's something, somebody would have told me along the way. It's just buck up and deal with it. And what I'm talking about here, and the reason this gets to be dicey and concerns business owners, is related party rent. So let me lay out a scenario for you. And again, we've been down this path many times. It's not that it's completely unallowable. We'll get into the details. But you have a situation where you have an owner of a company, right? And they're the owner of the government contractor company. And at some point along the way, they realize, hey, it's cheaper for me to own a building than it is to continue paying rent. And in fact, it'll be cheaper to the government because I can buy the building, rent it back to the other, I can buy this building as a separate legal entity. And let me pause for a moment and put up my parentheses. That's perfectly okay and allowable, right? And there are legitimate legal reasons why when we buy real estate, we put them inside of other LLCs, right? Because there's certain protections that we want for the property that separates it from the rest of the business and vice versa, right? Because we don't want somebody to come onto our property, fall, get hurt, sue us, and now we potentially lose not only the building that we own, but the business as well, right? We want to have that veil of assets so that it's very focused on what people can do. And there are legitimate business reasons, and that's perfectly okay and allowable. That said, you get a business owner that says, I can buy this building and rent it back at less than market rate and save the government money, right? It sounds good, seems to make sense. Let me give you a perfect example. And this is a client that we were dealing with a few years ago. They were paying at the time about, and I'm going to use simple round numbers, they were paying at the time about $10 a foot was their rental rate. The owner said, hey, I could go buy this building, and my effective cost of ownership is about $450 per foot. And if I then rent it back to the government contract company that I also own, I can rent it back to them for $6 a foot. I can still make a little bit of money in the real estate company that owns the building. I'm charging the government less, right? Because I was paying $10 a foot when I was renting it from somebody else. I'll lease it back to the government contract company at $6 a foot. So look, I'm saving the government $4 a foot, right, on this. That sounds like a good deal. However, the FAR is very clear here. And we'll go ahead and put some more information on the screen. When there's a related party transaction, and this also applies if you have a situation where there are multiple owners. It applies where you have a situation where you have different multiple owners that cross over. So we've had clients where the government contract company was owned by 3 individuals, but the building was owned by 3 different individuals, and there was an overlap. So I had 3 individuals over here, I had 3 here, but actually what happened is that 2 of the individuals owned portions of both companies. And so we had even though it wasn't a full 3 overlap, we had a 2 overlap, and it was enough for the government to say, you still have effective control over both companies, right? So when you have that related party transaction, again, it doesn't matter whether it's a single party or multiple parties, you're limited in rental costs if you have a separate legal company, which you probably should, you have a legal lease between the 2 companies. Your related party rent is limited to the effective cost of ownership. It basically means as if the government contract company itself had bought the building and owned it and maintained it. So that includes things like depreciation, utilities, taxes, insurance, repairs and maintenance, and the cost of money, okay? So I'm gonna back up again so we can see them again. This is, again, the effective cost of ownership, depreciation, utilities, taxes, insurance, repairs and maintenance, and cost of money. The cost of money is a different animal in the government contract world. I'll set that to the side for the moment. But you can see, looking at those other items, right, that if we owned the building, those are the expenses that we would have. And so the government says for related party rent, that's the limit of what you can do. So in this situation, what you have to do is actually, in the company that owns the building, you've got to figure out what the cost of ownership is. You got to tally up all of those things for the year, divide it out, figure it out, and that's the amount of rent that you can charge between the 2 companies. There is an opportunity to include a modest management fee, right? So, because obviously, and oftentimes, again, what we typically see, and I'm sure many of you have seen this, right? It's still the same bookkeepers. It's still, the same administrative people behind the scenes who are handling this stuff. So what we've seen is that in the LLC or other legal entity that owns the business, that owns the building, you can incorporate a modest management fee that is charged as part of that lease. But that's the only other fee that would be included in there. Really, really important. Again, this is a very common issue. We see it a lot. And it's, again, the other reason I say it's really important, this is one of those you will not win the argument with the auditor. you need to just calculate this and go forward. The cost of money bullet point that I left here on the screen, don't really have time in today's webinar to do a deep dive. Excuse me, we've talked about cost of money before. If you have questions about what cost of money is and how to calculate it, we do have a tool on our website that can help you with that. If you go to leftbrainpro.com, you'll see tools in the top menu. Click on that, the little drop down, and you'll see cost of money calculator. It's a facilities capital cost of money calculator that you can use to figure out what the cost of money is associated with the building and the portion that can be included in your rent. And if you've got questions on that, contact us, support@leftbrainpro.com, and we'll have all that contact information on the screen at the end of today's presentation. Another big area to talk about is travel, okay? Travel, in simplest form, you've got to be in compliance with the FTR, the Federal Travel Regulations, or the JTR, the Joint Travel Regulations. This means following things like per diem. Make sure you go to the GSA website, right, and look up per diem, and so just you know what the limits are for things like the hotel, meals, and incidentals. This is an area, usually the question and the frustration that comes up that we see is somebody will say, okay, in terms of hotel, how do I, so if I look at, let me back up. If I'm traveling and I go to the GSA website and I pull down the per diem rates, and I'm making up a number because I don't recall and they change some. Let's say I'm traveling back to Columbus, Ohio, and I've got to be there. And I look up and it says, Columbus hotel this time of year should be $150 a night. That's the only amount you can include in your rates back to the government. Let me expand on this. So let's say the cheapest hotel I can find is $170. I'll give you a couple of examples. Let's say I don't have a government ID, and this is one of the problems. I'll circle back to that. Let's say I don't have a government ID, so I can't get the government rate. And let's say the cheapest hotel that I can find within a reasonable driving range is $175 a night. That means when I fill out my expense report, I put $150 in the allowable column. I put $25 in the unallowable column. And then all of those taxes and resort fees, right? Because when you travel, hotels usually have a city, state, local, tourism tax kind of thing. You allocate it proportionally, right? So if it was 10% as an easy example, right? If my hotel was $175 and I would have $17.50 in taxes. Well, $15 of taxes would be allowable because your GSA rate is just for the base hotel. So any related taxes are always allowable, okay? So I have to break it out. If I'm breaking out and saying 150 is allowable and $25 is unallowable, then I have to break out the taxes portion of that as well. I said that, one of the complaints that we often hear from contractors and business owners will say, well, we don't have or we can't get a government ID. And that's often true, right? Because even though you're a government contractor, doesn't necessarily mean that you're doing work at a government facility, so you may not have a government ID. If that's the case, I'll just tell you to send me a separate email. I can give you some pointers and some ways to do that. There are some tricks out there to help you. Nothing illegal, but a couple of tricks that I could share with you if you'll send me an email to get you a government ID that you can use for your hotel stuff. But even then, sometimes the other issue that you run into, so you say, well, I don't have a government ID, so I can't get the government rate. The other issue that you run into, and you'll see this especially at hotels that are near either large government contractors or otherwise near a large government facility or a base. So for example, if you're traveling to DC and you want to get a government rate on the hotel, well, good luck with that. Right now you might be able to, right? Because not many people are traveling. But you try to find, a government rate on a hotel in DC, and it's nearly impossible. Same thing is often true for San Diego. Again, if you're near, it could even be a smaller area if you're near a base. And the reason for that is the hotels, they do have to provide a certain number, but they don't have to provide an unlimited number of rooms at the government rate. And I don't know what the magic number or percentage is, but what I've run into is that at times, especially if you're on short notice trying to book a hotel, is that you will contact them and they'll say, yeah, we don't have any more. One little tip that I'll give you is that if you're trying to book online and it comes up and says that the government rate is not available, generally indicating that they've already sold those rooms, pick up the phone. Just pick up the phone, call the front desk at the hotel. Don't call the 800 number. Actually, call the hotel itself directly. Make sure you're talking to somebody at the front desk of the hotel and say, hey, I'm coming in. I have a government ID, and I'm trying to book a government rate, and it says you don't have any more online. They may or may not, but you're never going to know if you don't pick up the phone. They may go ahead and give you the rate, which is really nice. Another trick, and I will share this trick with everybody on here. One thing that you can do and should do, if you don't have a government ID, you're going to be traveling for government work and you need to book the government rate, get your contracting officer to write a letter stating that you do have the government contract and you're authorizing them to use to get the government rate. It does work. Obviously, it requires a little more effort because you got to get your contracting officer to write a letter. It's helpful if they can, if you know the people who are traveling, and you can put their names in the letter that the contracting officer signs. That way, when you present it at the front desk, you know, the front desk clerk there can read the letter and say, Robert Jones is on this letter. They look at my ID and it says Robert Jones, and they can go, okay, this looks good, I can do it. If it's a generic letter, you're probably going to have more trouble, right, trying to get it through, because how do they know that Robert Jones is allowed, isn't in any way related to this contract, because his name isn't even on the letter. So that is one of the tricks that you can use to get that rate. Meals and incidentals. Again, this is an area you're not going to have any room for flexibility. You just need to follow what we refer to as the M&I. Follow the M&I rate for the per diem. There is a general rate across the U.S. It is adjusted for some of your larger cities. It's also adjusted for seasonality in some cities. So you want to make sure that, and that applies to both hotels as well. So you want to make sure that you do that. Little interesting note here about meals and incidentals. We have some clients who say, well, we reimburse actual receipts. We don't do the meals and incidentals. So here's our guidance, and I'll tell you why we do this. We tell people, pay your employees the meals and incidentals. One, it's simple, it's easy. You know what it is, the employee knows what it is, and it's no hassle. And the only thing you have to do from a documentation standpoint, right, is have a policy that says we reimburse M&I rate, you know, per diem from the GSA. As long as you have that policy, then when an auditor comes in, they say that's what the policy says. They will spot check and make sure that you're paying the correct rates, right, that you're supposed to pay. But then that's it. You don't have to provide receipts. You don't have to do anything else, okay? Simple, easy, straightforward. If you are still getting receipts from employees, then you got a couple of problems. One is that now you got to chase down all the receipts. But not only do you got to chase down the receipt, it's got to be the itemized receipt, right? A credit card receipt, when they go up, right? So let's say I go to the hotel bar, I get my burger. I'm a wine guy, not a beer guy. So I say, hey, I'd like to have a glass of wine with my salad. And also, by the way, I'm going to be the salad guy, not the burger guy. If you're inviting me to dinner now, you know. So I'm going to get my salad. I'm going to get a glass of wine. When I pay with my credit card, what happens? I get the generic receipt that said $28, right? It doesn't say the salad was $18 and the glass of wine was $10. You need that detailed receipt that says the salad was $18 and the glass of wine was $10. Because remember, $10 is unallowable, and here's what's going to happen. If you don't have, and we've seen this, I'm telling you, I've seen it, it will happen. If you do not, if you're reimbursing actual expenses, I mean, that's the big if. If you're still reimbursing actual expenses on these, and you either don't have a receipt or you don't have the detailed receipt that shows exactly what was included, the auditors will disallow the entire cost. So they're not going to say, we're not going to try to figure out what, if it was alcohol or how much was alcohol or anything else. You don't have a receipt to support your claim. We're going to treat it all as being unallowable. So you don't want to be in that situation, right? That's a difficult situation to be in. The other reason and I tell you this from experience, dealt with this where we had a client working through some issues with their travel policy and reimbursement and with a particular employee and getting receipts. And when we finally got receipts, what we discovered is that we were basically buying all of his alcohol. He was not eating, he was drinking, a completely separate issue that had to be dealt with. But they were reimbursing large amounts of alcohol that this person was buying. So obviously that becomes a problem because now as a business owner, business manager, you're aware of that and presents other legal issues potentially for the business to deal with. So if you just reimburse, and I think you should turn your head otherwise, but if you just reimburse the meals and incidentals rate, what your employees do with the money is not your problem. And you're not getting receipts and you don't have to chase them down and you don't have to sort through that. Carrying on with travel. Again, I told you there are a couple of these topics, but there's a lot involved, so there's a lot to chat about here. Carrying on with travel. Airfare is a big one. This is another one where, and I used one of my examples earlier, and I'm going to reuse it here for this reasonable aspect. I quoted the FAR here and put it on the screen because it's really important. People misunderstand this. So I wanted to highlight this. Airfare cost in excess of the lowest priced airfare available to the contractor during normal business hours. That part there that I bolded, that's really important. This does not say you have to take the cheapest airfare. So remember my example that I said if I wanted to fly back to Columbus, I could look it up. And I'd probably see some rates anywhere from, and again, I wouldn't be surprised, probably $149 to $3,000. And most of them are going to be somewhere probably around $400 to $500, right? Because that's about average to fly from California to Ohio. Well, the $149, one of those cheap, and I won't pick on any particular name, but it's one of those super cheap, cutthroat airlines where you got to pay for a napkin, right? Probably got to pay for a seatbelt, I say jokingly, right? But the other thing, it's not so much that, but it's that flight is only available at 3 a.m., right? They have one flight a day, it's 3 a.m. And oh, by the way, they also only fly from California to Columbus 3 days a week. So I've got to fly at 3 a.m. a day early to get there just to get the $149 fee. This clause does not say I had to get the cheapest one. This said I had to get the lowest priced airfare available during normal business hours that also otherwise meets and look at that last sentence, that meets the mission requirements, okay? So if my mission says I got to be in Columbus, so today's Tuesday, let's play this out. Let's say it says I got to be in Columbus for a noon meeting on Thursday. Well, I can tell you right now, I'm 3 hours behind, right? So that'd be 9 a.m. here. I've got to leave here sometime Wednesday to get there for a noon meeting on Thursday. So I just need to look at what would be my normal business hours, or what would I normally travel and fly on a Wednesday. And, when I take that, and I also take out the other end, right? I'm not going to fly first class, and we'll get into all of that, right? I'm not flying first class. If otherwise those flights, are all hovering in that $400 to $500 range, I need to pick one of those flights. And again, it doesn't have to be the cheapest one, right? Because one could be cheaper because it's one airline versus another. If we have a regular, and I'm, and I do fly a regular airline, right? Because I get my miles, I have my loyalty. That's okay, right? I can, if one flight is $25 or $50 more than the other, that's not where the concern is. The concern is that they want to make sure you're not getting the most expensive trip. Also note some of the things in here, and I've seen this happen before, where somebody booked and they said, oh man, I got to get the cheapest flight. They booked it, and the next thing I knew, they had 3 stops flying from DC to LA. And I ran into them and I'm like, hey, how was your, we were going to a conference. And I'm like, well, how was your flight? And they're like, oh, it took me 26 hours to get here. And I'm like, what do you mean it took you 26 hours to get here? Well, I stopped in Detroit and Chicago. And I'm like, what? Okay. It doesn't say that you got to make 3 stops. It doesn't say that you got to fly halfway around the world to get there just because they got some cheap route. It's not about that. Again, it's got to be reasonable. It's got to be in business hours. It's got to otherwise meet the mission requirements. So hopefully that dispels some of the myths that some of you may have had around airfare and the allowability of travel costs. Now I want to talk about that directly associated costs. Remember, it's been a few minutes ago, we were talking about lobbying costs. I said that lobbying costs are generally unallowable. And I said there can be directly associated costs. Now, there can be directly associated costs with a lot of costs. I just happen to pick on lobbying, so just keep that in mind that it's not all. These directly associated costs can apply to any cost. I'm just using my lobbying as an example. So I said that lobbying was unallowable. Well, a directly associated cost is any cost that is directly associated to any cost that is generated solely as a result of incurring another cost. Well, it says, and when that unallowable cost is incurred, its directly associated costs are also unallowable. Let me give you an example. I said that lobbying was unallowable. We had a client who was paying a lobbying firm. Nothing illegal, nothing wrong with that. Just can't include those costs. What we later learned was that the owner of the company was flying to DC to meet with the lobbying person and attended some meetings with the lobbying person. Nothing illegal about that. Let me be clear. It has nothing to do with that. May or may not be tax deductible. Again, separate conversation. But the government said the lobbying costs are unallowable. So the cost of the owner flying to DC to meet with the lobbyist is unallowable. The owner's time that they would otherwise charge, right? So they got to charge that time somewhere. That time is now unallowable. So that means it can't go into G&A, can't go into overhead, you can't bury it. It's not about that. If they otherwise would have charged G&A and now they're traveling to do this stuff, nope. That cost is unallowable. So the travel, the meals, the rental car, the airfare, the hotel is unallowable. Their time is unallowable. Other examples include, in addition to the lobbying efforts, and Liz, we do have a polling question coming up in a moment. In addition to the lobbying efforts, some other common ones that we see are trade shows. We didn't talk about trade shows, but they are generally unallowable. There's a limited exception in there for allowability, so generally unallowable. Holiday parties, again, great thing to do for employee morale. It's the right thing to do. Those are unallowable. All of the associated costs for those are unallowable. So if the trade show itself, so let's say it's $5,000, right, to buy a spot, right, to rent a spot to set up your exhibit booth. Not only is that unallowable, but the time your business development or marketing people are there, their time is unallowable. The travel, the airfare, hotel, meals, all of that stuff related to it is also unallowable, as well as the shipping, right? Because now you got to ship this big exhibit booth there. That's unallowable. All of those expenses are unallowable. With that, I'm going to give my voice a rest and let Liz kick us off a polling question.
Okay, that sounds good. That was a big section. So let's recap and ask the audience which is considered an allowable cost. So we talked, I think, in pretty good detail about advertising, lobbying, alcohol, job postings. So let's go ahead and just watch those responses come in, which is considered an allowable cost. We'll leave this open for about 5 more seconds here. All right, very good. Thanks everyone for your responses. Close that down and share those results. So it looks like we have an audience who's really tracking along with us, Robert, responding job postings. That's considered an allowable cost.
That is correct. And job postings are allowable. General advertising, which we were talking about in conjunction with job postings, is unallowable, right? That general advertising is, hey, look at us, look how good we are, look how smart we are, you should hire us, unallowable. All right, let's carry on. We've got some more information to get through here in the next 20 minutes or so. So now that we've talked about all these, the background of unallowable costs, we've talked about some specific unallowable costs, how do we treat and handle them in our accounting system and in our policies and procedures? One thing that we tell people is segregate the chart of accounts. And you can do that a couple of different ways. Separate GL accounts. In particular, we prefer that 9 series of accounts. Again, if you were with us when we did the indirect rate stuff, and actually back in the fundamentals, I'm sorry, the foundation course that we did in January, which was the first in this series, we talked about that chart of accounts, and we said the 9 series of accounts we used for unallowable and other types of transactions that we needed to capture. The nice thing about that is it's clear. Auditors come in and they say, we want to see your policy on unallowable costs, we want to see your chart of accounts, and you can show them that your chart of accounts is broken out and that there are actually dollar amounts that have been posted there. That gives an auditor a huge level of confidence that you're doing the right thing. Now, they're still going to test, right? They're still going to ask questions and do some transactional testing and things like that. But they're going to look at it and say, hey, they've broken these out from the others, and it's less likely, that there's an error in them. The other thing that I would point out here is that we've seen some clients who like to take the approach and say, we're going to have separate GL accounts, but we're going to keep that GL account in line with the other accounts. So what I mean is, let's say you have, let's do the advertising. Well, they might have an account called advertising-job postings and one called advertising-general. And they're separating it out. And they know that advertising-general is unallowable and advertising-job postings is allowable, okay? Perfectly okay, you can do that. You can show the auditors, hey, we have 2 separate accounts, we are breaking them out, we're treating them appropriately. The problem that we run into, and I'm gonna go to my next bullet item here. One, it's really helpful that if you put like UN or unallowable or something clear in that description so that when somebody is selecting that account, they know they're selecting an unallowable account. That's also one of the reasons that the 9 is helpful. We like the idea of having a 9 and using UN at the beginning of the description, because then it's just a double reinforcement that somebody selecting goes, wait a minute, this is an unallowable cost. I know I have to find it. I know I got to go to the 9 series, right? So they got that kind of in their brain. And then when they're looking there, they see all this on. It's just that reinforcement that they're in the right area. There's a much better chance they're going to select the correct account. If you don't have on or unallowable in the description, especially if you take this commingled approach where you keep advertising general and advertising job postings side by side in your GL, then there's much greater chance that somebody picks the wrong one. They don't understand which one to pick or why to pick it. The other thing that becomes problematic, again, remember, unallowable costs have to be excluded from our rates, or they have to be excluded from the pool. They're included in the base, which we'll talk about in a moment, but they're not billable back to the government. And so if you keep them in line with the other accounts, you run the risk that somebody starts running reports using a series of account numbers, right? So instead of individually selecting the appropriate accounts, they say, oh, let's take all of the 7001 through 7999 accounts and we'll use that as part of our thing. And if you've got, even if they're separate GL accounts, but they're in that series, right, and somebody starts running reports and calculations, you can see where now all of a sudden you could end up with the wrong rates and the wrong information. And that's one of the big reasons why we tell people to break them apart. You need to make sure that you track those directly associated costs. So again, my lobbying example, one that's really, probably the 2 that are really common because we don't see as many clients being involved in lobbying. The 2 that are really common are trade shows. Again, legitimate business expense, just not, an allowable expense. Even if you go to a government contracting thing, people say, well, I'm going to a government contracting conference. Isn't that allowable? No, not the business. As an attendee, yes, right? If you're going to pay your $500 to go learn and stuff and check out the booths, that's fine. That is likely an allowable expense. But if you're saying, hey, we're going to take our exhibit booth out there and tell people how wonderful we are and show them our products and services, you can see how that looks like advertising, right? Which is unallowable. So this would also be unallowable. But where people get caught up is they say, okay, well, we charge the trade shows unallowable. But again, you got to remember that if you're sending business development or marketing people out there, their time for the time that they're at the booth and doing that work needs to be marked as unallowable, as well as all of those travel costs. Okay. Another common one is the holiday party, and the reason I point this one out is the holiday party itself is unallowable. But what happens? We usually have an admin person who spends a lot of time planning and organizing the party. All of that time is technically unallowable, okay? Have a report of unallowable costs. Again, if you put them all in the 9 series, and it's really helpful to runner to have a report that says the unallowable cost report, and it's all of those 9 series of accounts. And then again, you can present that to an auditor and say, look, here they are, they're completely separated. You need to make sure that unallowable costs are part of your expense report policy, and that it's clearly delineated how people are to, what are the general or common unallowable costs that a traveler would incur, how they are to handle those. And you need to do annual training. I've said this before, we recommend some of this annual training to be part of your open enrollment period for insurance, because that's usually one of the times of the year that you kind of have everybody together, you have everybody's attention. It's an easy time to incorporate some of this additional training. Other things for best practices, again, I mentioned this, you've got to have an ability to identify and mark certain costs as unallowable, whether it's on an expense report, requisition, and purchase orders. Make sure you document. In the case of travel, take screenshots of airfare, hotel, rental car rates, so that, because the problem is that those things, all of those rates change on a daily basis, and you cannot go back in time and say, well, what was the airfare on that date, right? Because these things don't get questioned tomorrow. They get questioned next year or 2 years from now sometimes. And there's no way to go back, right, and say, well, what was the airfare on that day, right? Take a screenshot. That's the easiest thing to do. Put it in with the expense report, and then, it's easy for somebody to go back and validate and say, hey, here's a screenshot. It was $129 to $3,000. You'll see there were several here from $400 to $500. I chose the one that was $475 because that's the airline I normally fly. Not a problem. Nobody's really going to question that. Make sure you write up any instance where you claim something higher than the FTR or the GTR per diem. Great example for travel. So here's another little tip. Let's say you're traveling for some training or to attend a conference, not necessarily to be there for the trade show booth. Let's just say, you're going to go do some training, right? And you're going to be at the conference. And let's say it's in a big city where it's very expensive. And as I said, maybe there are no more government rate rooms available, right? And so maybe the government rate is $150, and let's say the cheapest room you can find because it's a big convention is $200. And you say, well, wow, that's $50. Okay, and I'm sure many of you have done this, right? We've gone to a big city, and guess what? We don't get a rental car, right? We just stay at the hotel, so I don't have a rental car. I don't have to pay for gas. I don't have to pay for parking and other stuff, right? Because I'm going to be there at the hotel where the event's going on. Maybe I have, an Uber ride back and forth to the airport or whatever. But otherwise, I don't have those other expenses. And it saves me time, right? So yeah, I could get a cheaper hotel, but it's, it's 10 or 15 miles away, and I'd have to deal with traffic, right? Just jot that down. I'm not saying it has to be, a huge, long document, but you could say, employee was traveling for conference. You can show the rates. You can say, there's no rental car, there's no associated costs, and that way, at least you can show that, even though my hotel was higher, I would have had these other expenses that would have otherwise been allowable and been equal to or even likely higher than this increased rate for the hotel. So you always have that option. The other thing that I would tell you with that as well is if you are in a situation where that's going to happen, particularly if it's a direct cost. So if you're in a situation where it's a direct cost, you've got somebody traveling and you can't get a rate, get your CEO to approve that. Get him to say, and put it in writing and say, okay, we approve, we will pay for this higher rate because we recognize, that there are really no other options. Make sure that you eliminate the low-hanging fruit. I've said this a few times today, right? Pick your battles. There are some things that are just not worth fighting with the auditors because you're just not going to win. So, get some of this right. The alcohol, you're not going to win that. Travel, pretty straightforward. Charitable contributions, interest and finance charges. These are some things we talked about today. There's related party transactions. Go ahead, get them out of your rates because guess what? they're going to be challenged, and it's not going to be a positive situation for you. Penalties. Really important here that there are penalties that are involved with unallowable costs. You'll find this in FAR 42.709. The penalty equals the amount disallowed. Oops, sorry, there's an error on the screen there. If an amount claimed is an expressly unallowable amount, then the penalty equals the amount that was disallowed. I've got a couple of examples I'm going to walk you through. So that means if you had a $25,000, and this is looking like across the year, it wouldn't necessarily be a single amount, but we've seen situations where after an audit, the government says, okay, we've tallied up, you had a total of $25,000 in expressly unallowable costs that you claimed. So the $25,000 is disallowed because those were expressly unallowable. The penalty is equal to the disallowed amount, which is now $25,000, plus interest. Okay? If the amount was determined unallowable for that contractor prior to the proposal submitted, so let's say it's part of, and this goes back to that complying with the terms of the contract. Let's say it's part of the proposal, the RFP proposal process and the award. It was deemed that a particular cost was going to be unallowable, and you went ahead and later claimed it and included it in billings and in your incurred costs. Now the penalty is 2x, right? So in the case of a $25,000 amount that was disallowed, you'd have $50,000 of penalty plus interest. It's important to note here, it is not necessary for the unallowable cost to have actually been paid to the contractor in order to assess the penalty. So what that means is when you prepare that incurred cost proposal at the end of the year, and you claim that amount, even if you didn't actually invoice that throughout the year, because that incurred cost proposal was, you're reconciling what was invoiced versus what you actually incurred. Even if you hadn't invoiced the government for that amount yet, the fact that you claimed it and included it in your rates, they can still come back with the penalty even though you never received the cash. This penalty and stuff is really, I can just tell you a couple of horror stories. We had a client a couple of years ago, we did not win the work, quite frankly because they didn't like my answer when I said, and what it was, they had already gone, unfortunately they had already gone through an audit. There were several findings to the tune of $500,000 of unallowable costs. They wanted to fight with the auditors on it, and so they wanted to hire us to fight with the auditors. We looked through the file, and I said, you know, there are a couple of, and unfortunately, I mean, they had a number of clearly identified expressly unallowable costs. They were not going to win that argument. They had a large amount of disallowed costs because they didn't have those detailed receipts. Again, you're not going to win that argument. If you don't have a detailed receipt to support your claim, the government's just going to simply disallow that cost. They had a total of $500,000 across a 2-year period, I believe. And it was a 2-year period that was, they were already behind 3 or 4 years. And I'm going to show you an example on the next slide here. It gets ugly really quickly because as you'll see here with my calculation, that in a situation where you had $25,000 of unallowable cost, and this actually came from, I rounded the numbers, but this came from a real example a few years ago. They had $25,000 of unallowable costs. So the penalty was also $25,000. That meant that my principal from that year was $50,000, right? That I owed the government, because I owed the government the $25,000. I shouldn't have billed them. Plus I owe them the $25,000. And note, by the way, the interest on the penalty amount goes back to the original date. So in this situation, a $25,000 unallowable cost resulted in our client paying the government $68,577 back because of a known error that they made in their incurred cost proposal. With that, Liz, a polling question. I think I've got a couple of other slides and we can get to the Q&A.
Okay, that sounds good. So this is our 5th poll. So we do have 2 more polls that we want to make sure we get to in the next 3-4 minutes here. And I know that Jenny has some questions she's been gathering from the audience. So for this question, claimed unallowable costs on ICP and billings result in which of the following penalties? So Looking for those results to come in pretty quickly. A little bit split this time. So common denominator, it looks like most people are responding with plus interest, but a little split between 1 times and 2 times. So Robert, I'm going to get ready to close that poll. And while I do that, do you want to let us know what the answer is?
Yeah, so remember, these are unallowable costs. That's the 1x. The 2x only comes into play if it was something that was identified for that contractor. Right? So if it's just a regular unallowable cost, it's 1x plus interest. All right, so really quickly here, because again, we've got some information and 2 more polling questions to get through. The impact of unallowable costs on indirect rates, simplest form. I said earlier, unallowable costs are excluded from the pools, right, because we can't bill it back to the government, but they are included in the base as appropriate. That's in alignment with CAS 405. Example, if tongue is tied. If an unallowable cost is otherwise direct in nature, it's also included in the base of fringe, overhead, or G&A as appropriate. Got a little example. You may recall seeing this when we went through the indirect rates slide. I reused a slide here. My example here is where I had some unallowable direct labor. Because it's labor, it does get fringe. Because it's direct labor, it's in the base of overhead, so then I have to apply overhead to it. It also goes into the base of G&A. So not only, the point that we're driving home here, not only do I have the unallowable cost, but I also have the unrecovered fringe, overhead, and G&A. And you can see in this case here, and again, I've got some crazy made up rates, but this stuff can be true, that my unallowable cost of $18,000 turned into almost $37,000 of total unrecoverable costs, because again, not only I can't bill the unallowable cost itself, then I also cannot bill the associated fringe, overhead, and G&A. Another polling question, Liz,
All
please.
right, very good. Unallowable costs plus unrecovered indirect costs equal, what's the term that describes this sum?
And I see people are getting the right answer, and are running short on time here. I see we're up to about getting most people who are participating.
Yep, I'll go ahead and close this down in just about 30 seconds here. Looks like there's still some answers coming in. Okay, we'll close that, share results. Okay. Correct answer?
Yeah, and the answer is total unrecovered cost. Total unrecovered cost. So I won't bore you with all the words on here. It's a complex. I think you guys realize from what we went through today, everything we talked about, unallowable costs are very complex. If you've got questions, you can always contact us. You can download the presentation and others on our website, leftbrainpro.com. We've got some tools out there. You can always send us email questions, support@leftbrainpro.com. We're on social media. We're pretty active out there, thanks to Jenny and all of her efforts. So you can find us on LinkedIn, Twitter, Facebook. We have a YouTube channel now with training videos, and Instagram. With that, our final question or final poll, and then I'll try to answer a couple of these Q&A. Jenny, maybe you want to go ahead and start giving me some Q&A questions while people are answering the poll.
Yes, and before you jump in, Jenny, just to want to make sure that for that final poll, if you would like more information about accounting for government contracts, I know Robert would be more than happy to schedule a phone call with you or just keep in touch via email. And I'm going to drop the registration link for next month right in the chat box. So Jenny, with that, go ahead.
Great, thank you, Liz. The first question we had come in, are job fairs and associated costs an allowable expense?
Job fairs would be, right? Because, just like job postings, yes, allowable. A job fair, so let me clarify, as long as it truly is a job fair and your HR person is there and that's what is going on, then yes, it's allowable. If you're at a regular trade show and you got a little sign up that says we're hiring, that's not a job fair and that's not allowable.
Great. Our next question, in times of an emergency, in other words, a pandemic, wildfires, etc., are there unallowable expenses that become allowable?
That's an excellent question. I thought that was going to go a different way. Part of the way I would answer that would be certainly things like hotel, airfare, other things like that, where we start talking about either reasonableness of a cost or, again, the availability of costs that are like a hotel room, within the per diem rate, stuff like that. And then obviously, you have to address as is. Trying to think at the moment, would there be any other specific unallowable costs? I can't think of any. Those would be the kinds of things that would come to my mind. Again, reasonableness or travel expenses that would be beyond the norm.
Okay, we actually had another question come in. Trade show cost is completely unallowable?
There is a very, very limited exception. I would tell you most trade shows. So, if it's the National Association of Accountants, I'm making up something, right? So if it's the National Association of Accountants, that's probably not a good one. Let me think of a better one. If it's the National Association of Shipbuilders, right? And you're a shipbuilding company for the government and you think, hey, I'm going to go and I'm still selling government stuff, it should be allowable. Most likely not. There's a very, very limited exception in there. And generally it has to be called out and be a requirement of the contract. And quite honestly, I've been doing this 17 years and I can't think of them at the moment of any time where we ever had a trade show that actually met the requirement. So it's pretty slim. And with that, I know we're at the, and I was gonna say, I know we're at the end here. I just want to say thank you. Again, we've got self-study courses that are available that have been converted, and come back next month on September 22nd, where we will talk about timekeeping and labor distribution.
Yes, well, wonderful. Thank you so much, Robert, for an excellent presentation. And Jenny, thanks for helping with the Q&A. Just a quick reminder that we'll have a course survey following the program. We would love your feedback. The box will pop open with the survey questions after you close the GoToWebinar control panel. And you can log into your Incourse user account to access your CPE certificate, the recording of the program, and the materials later on this afternoon. So thanks again. We look forward to having you back with us again next month. Take care.